Hi there, it's Bill with Smart Trades, and it's noon on July 8th on the West Coast, about an hour before the close. And today I was going to look at the Nasdaq as well as Google, since somebody had asked about the Google chart, and I think it is interesting. I watch Google quite a bit, not necessarily to trade it, but also to watch it as an indicator for the broader market. But first off, I wanted to review the Nasdaq 100 cash, and right off the bat, let's just look at the angles of various downtrend lines that we've had over the past 10 years or so. And first off, here's the peak back in 2000, and the angle of that decline off of that high is about 84%, and the angle of the decline off the 2007 peak is about 63%. It's pretty clear that pretty sharp declines on those initial declines off the tops. And I want to bring your attention, relatively speaking, to the current decline, which has a much shallower angle, about 22%, and these other angles of decline are also relatively shallow, 10%, 23%, and off the bottom in 2009, about 14%. So I think if you look at the relative angle of decline of so far, although it seems to be steep when you look at it on the short-term basis, when you compare it to the larger magnitude initial thrust down, it actually looks more corrective to me than impulsive to the downside. And the message is, again, that perhaps our decline is indeed the beginning of a corrective decline. I'm going to go back here just a bit to and review some of the other declines that we had on the way up back in the 90s. And keep in mind that the famous bears were short back in mid 1993 right here. They were short again in early 94. Short again in early 95, short again in early 96, short again in early 97. I've got some newsletters, that are missing actually from the 97 through about 2002, but rest assured they were short then too. And if you'll see, again, look at the basic form of these declines that, if you look more closely, you can label them as Elliott ABCs, but I think sometimes it's good to have a little bit of blurred vision when looking at the market. In other words, you want to look at the bigger picture. You want to look at the general pattern. And all the way up, you have a pattern of impulse, followed by corrective decline, followed by impulse, followed by corrective decline. And as long as you're getting those corrective declines, you want to respect the possibility or probability that you're still in an uptrend. And here you can see how we resolved this with that parabolic rise in the tech bubble into 2000, and then that sharp decline. So, and again, here's the more recent picture. So, one caution I do have looking at this chart, is the possibility that we're actually trying to carve 5 waves up off of the 2009 lows. Actually, in the Nasdaq, that's the 2008 lows. We did not make a new low in March 2009. But at any rate, if you'll notice here, we have two similar magnitude corrections. The first one off of that low in 2008, and the one that we're currently in. It sets the stage for a possible, final leg up, a fifth wave up to the top of this triangle, and to the top of this trend line, trend channel. And when you look at this broader picture on the monthly chart, you can see the possibility that this whole pattern could be labeled as a giant A up, B down, and this would be 5 wave C. Now the target up there, and this would be several months out at least, but we're talking the area around 2300 for the Nasdaq. Whether or not we're going to get there, I don't know, but when I do look at this chart, that's that's one thing that you know, you look at and you just can't help but see the possibility that you've got an impulse, and that it could be counted in the C wave position. So just a cautionary note for the months ahead. And let's take a look at Google now. And I'm going to switch to a weekly chart. And the obvious count to me off of the recent highs is that this is a 5-wave structure down, and that can be either you know, 5 waves with an A or 5 waves in a larger decline of 1. There are other ways to count it, but before we get into that, I also want to bring your attention to the decline off of the 2007 peak. And to me, the best way and really a pretty clear way to count this is that this entire decline is an A, B, C, a corrective decline. Now, it's possible that that whole decline is just A and that we're embarking on another similar magnitude decline. But you know, as we looked at, you have to respect corrective declines, and the rally back up, although it's kind of an iffy count, it's mixed. I think it can be counted as an impulse structure, and if it is, then you're looking at a corrective decline and then a rally back above the late 2009, early 2010 highs for Google. Anyway, let's expand this back out a bit, and I want to show you one other possible count for Google. And the idea is basically that we have a zigzag or a double zigzag in progress, and let's go ahead and label that. So A down, B back up, C down, and then you've got a contracting triangle. Now triangles can either be in 4th waves or B or X wave positions, so let's go ahead and label that X, and then you have A down working on B back up, and then C down into this support level. And the nice thing about this is it fits pretty well with our large double zigzag pattern in the Nasdaq and the S&P. And also it would target the area around 400 for Google. You have a prior congestion there. There's a variety of calculations you can also do to look for relationships between the first ABC and the second ABC that would again target that area, give or take 20-30 points around 400 or so. So and you know, that's one alternative to the impulse structure to the downside. So, and finally, let's take a look at the short-term picture in the S&P. Here is the S&P hourly chart, and I've compressed it a bit so you can see the broader count here. And again, we have ABC down, X back up. I'm counting this as A down, and then B back up. And my initial target was 1075. We've hit 1071.25 today. I doubt that's it. It looks like it's got higher to go. And on the note of corrective types of patterns, you can see here that, you know, classic, you know, falling wedge pennant type pattern off of the highs. The implication is that we're at least going to go up and try to fill that gap. That remains to be seen, but you know, that's how it looks to me. I'd respect that at this point. And the possibility that we could even go higher, again, that if you look at the trend line coming down off the top of our double zigzag, it's still up around 1100. So this pattern could evolve and go a little bit higher before we see our C wave down. And that's about it for now. Hope you're having a good one, and if I don't talk to you, have a great weekend. Bye-bye.